Okay, welcome everyone to the day 3 of the Farms.com virtual precision ag conference. My name is Agostino, Chief Commodity Strategist with Farms.com Risk Management. And today we're going to take about 20 to 30 minutes, depending on questions. Our topic is maximizing precision ag yields into profits the last 2 days or 3 days. You've probably learning a lot about how to increase those yields, and we're going to try to educate everybody on how to make more money with those higher yields, and we'll give you some perspective and insight as to where prices are headed. So today I'm going to talk a little bit about the global picture. I'll start with that, then we'll dumb it down into the local area, and we're going to start with an outlook on soybeans. We're going to do canola, we're going to do corn, and then wheat. But if you have a question on some other topics, feel free to ask those as well. So without further ado, the phase 1 trade deal with China under a Biden presidency. This one's surprising me, but nonetheless, it really doesn't matter who's in office. I think Trump started the whole phase 1 trade deal with China. I think Biden and his administration are going to remain tough on China, and hopefully we can continue with this in 2021. And hopefully, there's a year or two to phase 1, and then hopefully maybe Biden can take maybe some of those tariffs that Trump has introduced as part of his strategy to fight against China. Maybe he can take some of those tariffs, maybe remove some of those, and negotiate a phase 2. So I'm looking forward to this continuing in 2021. We're about 70% of commitments, a little bit behind, but the end date is February 14th. And I think China has come out and said that they want to continue to do business with the United States. The November USDA crop report was quite bullish. So these are some of the factors that have caused prices to rally here since the lows in August. Ending stocks on corn came in at 1.7 billion versus 2 billion. Ending stocks on soybeans came in at a very tight 190 million bushels, a 4.2 stocks to use ratio, 4.2%. That is very, very tight. We've also got a La Nina. That La Nina showed its heat and dryness for many parts of North America this year, just a touch of what it's capable of doing. It's throwing a lot of dry weather in South America now, Argentina, and big growing regions of South America, and it's going to continue through the summer of 2021. The last big La Nina we had was 2012, and the last La Nina, it was a weaker La Nina in South America, was 2017-18. And when you're in a La Nina year, anything's possible. The funds have been buying a lot of the contracts, a lot of the grains, a lot of commodities from corn to soybeans to canola at record strong long contracts. Part of it has been better fundamentals, part of it demand. So it's a demand-led rally, but you also have a supply push rally where supplies have become smaller. You add in some La Nina weather threats around the globe, and it's almost a perfect storm for higher prices. And we think that that's going to continue. Lower US dollar index is helping US exports, particularly wheat. If you can, if we get another stimulus package from the US here in the new year, that could put some pressure on the US dollar. I think though by the second half of 2021, if the global economy and US economy is recovering from COVID-19 and vaccines, perhaps the dollar may start to rally again. But that's putting pressure on the Canadian dollar. It's putting upward pressure on the Canadian dollar. So the Canadian dollar has recovered from the 5-year lows in March up to that 77 cents. That seems to be resistance. The support comes in around that 74, 74 and a half. So I think until we know more about the economy and the recovery, and where that US dollar is going, or maybe even crude oil, I think the dollar's range bound, stuck in a range, but it could be a risk for basis going into 2021 for Canadian producers. Stocks are on a rise, down now near that 30,000. We were projecting 30,000 at the March COVID-19 lows. Some are now saying with a recovery in the economy, we could see 40,000 on the Dow next year, by the end of next year, up 35%. Some are projecting S&P up about another 12%. Those are amazing numbers. don't forget the stock market is a discount mechanism, so it's always looking out 6 months ahead. And at this point, the stocks are saying basically that they see good times rolling back into the economy. Crude oil, it's recovered from the COVID March, April lows, but it's remained range bound because there's still too much supply and global demand is off. We still haven't reintroduced fuel demand, jet fuel demand for flying. So we maybe started driving a little bit more, but we're still missing a lot of those planes in the air. But that could improve as we get into the second half of 2021. So we don't see a runaway market in crude oil, but we don't see a retest of the lows around 25. There's going to be an upward bias, particularly as we introduce the vaccines. So crude could be 50, $60 by the end of 2021. U.S. soybean ending stocks, as I said earlier, uh, um, um, a low stocks to use ratio of 4.2. That's very tight. You can see the last 3 years we've been falling. It doesn't improve much as you get into 2021, 22. I'll get to that here in a second. Exports record strong. We're now at 85.6% of the USDA target at 2.2. Some are now in the trade thinking that we could get to 2.35 billion bushels. That's very strong demand. That breaks the 16-17 record high at 2.250. Crush demand also record strong. Capacity issues here, but October crush was an all-time high. Here's the USDA balance sheet for next year, 21-22. So there's some in the trade saying that we're going to add about 7 million acres, about 180 million acres between corn and beans. We had a lot of prevent plant acres this year, about 10 million plus. So that's probably going to come back into the rotation. But even if I add 7 million acres to soybeans, and I being very conservative with crushings and export demand, ending stocks actually decline. And that's with 190 today on old crop 2021. If that number could easily keep coming low, keep going lower, you would actually have to add 14 million acres to make a huge difference in order to rebuild that pipeline of soybeans. And I was using 51. If we get to 55, you get to 690, but it's going to be a struggle. So I think prices are going to remain quite high, and I think they haven't done enough of that rationing, and I think that's going to have to continue as we get into 2021. South America remains in a moisture deficit. You can see from this chart, current 2-month rainfall deficit. It remains dry. There are some rains that keep falling, and it kind of helps, and I think the crop's limping along. But many in the trade think that we may be um, reducing the production from 133 million to 125. In the 17-18 weak La Nina, we had production come down about 9. So all eyes on South American weather. Next 5 to 6 weeks is very, very critical. Key support in soybean futures is 1080, resistance 1140, but just yesterday we got to 1189. Next resistance is 12, and then there's one around that 1252. But it looks like beans are headed to beans in the teens in the coming months. Canola. Let's talk about canola. Canola surprised everybody because of stronger crush, stronger demand, stronger exports. You can see ending stocks have been falling as well over the last 3 years. Exports record strong, and we haven't even we haven't come to the end of the marketing year. Some think that this is going to slow down, but I haven't seen that pace slow down at all. Higher Chinese meal demand, key to the higher vegetable oil. So there's less palm oil supplies. And so China, a bunch of other countries are bulking up for COVID-19 restrictions, and they're looking for substitutes like soy oil and meal to help replenish some of those lack of supplies from palm oil, and it's spilling over into higher bean prices and canola prices. So the key to canola is strong demand and that higher vegetable oil market on a global basis. If you can call the top in that, you're going to call the top in canola, but I think we could still move higher. Tight Brazilian soybean ending stocks also a problem. You can see from the chart there, and with a La Nina having an impact right now, there are concerns that it's going to remain tight. Palm oil, the futures also hit an 8-year high lower production, record strong demand, and soy oil also hitting a 2000, I believe it's 2014 or 16 high. Resistance comes in around 38 to 40. Key resistance in canola is around that 580 to 600. Who would have thought we'd be at 570 this time of the year? So this has surprised many folks. Let's talk about corn. Corn ending stocks are lower, 11.2%. Remember, just this about 6 months ago, some were talking 3 billion bushels in ending stocks, and we're down to 1.7. We've literally almost cut it in half. Will China become the #1 corn importer? USA attaché raises corn imports to 21. We've sold about 10. US has sold about 10.5. Many are concerned that we may not ship all of what they need, but this is real demand. China has auctioned off 2 billion bushels, and yet the price of corn in China is still in that $9 to $10 a bushel. So look for China to continue to import more corn. That's bullish for the balance sheet, bullish for prices. Some are thinking that this could be 20 to 25 million. Not only this year, but even into next year. Gasoline demand or ethanol demand down about 10%. The new lockdowns on COVID-19 are weighing. It's gonna be tough to keep bases firm if ethanol is not part of the equation. Exports record strong. You can see that from the chart, the black line. So key resistance in December corn. Well, December or March, it's in that 424 to 430. Target of $5. There's a lot of folks coming in with a 475, $5 target by July or August of next year. All wheat ending stocks. Let's talk about wheat. They've been falling just ever so slightly, but global wheat ending stocks are too high. They're record high, and that's what's been weighing on the market. But many in the industry are hopeful. The bulls are hopeful that a global economic recovery will help demand and therefore pull wheat prices higher along with both corn and beans. U.S. wheat export demand up 12%. Lower US dollars helping there. Wheat futures, though, is a weather-driven market. Unlike corn and soybeans, where the fundamentals are quite bullish, better demand, lower supplies. Weather markets can come and go very, very quickly. So there's been some dry weather across the globe, from the EU to Ukraine to Russia to Southern Plains, U.S. Southern Plains. So hard red winter wheat country is dry, but the soft red winter wheat country has plenty of moisture. And of course, Argentina and South America. So Chicago wheat key resistance is around 640. We could see a rally to 680 by year end, really mostly because of a play along higher with corn and soybean futures, support at 6. Kansas City resistance is 580 to 6, support at 540, and then Minneapolis wheat resistance coming in at 6 versus support at 550. Don't forget, if you need some help with marketing, we have our new mobile marketing app. It's quick insight analysis, marketing recommendations at the tip of your fingertips on your smartphone. That's it from me. I'm a bull. I think prices have to go higher because we still have to ration more demand. I have not seen any top formations on the charts. You're just going to have to be patient. If you don't have storage, so maybe you've done harvest and maybe you need some cash flow, you got to remain offensive. In other words, book a basis with your commercial elevator. Do not pay the 6.6 cents per month to store corn or 8.7 cents on beans. Thank you, everyone. I will now open it up to questions.
Okay, thank you, Mo. That was fantastic. So if anyone does have a question, feel free to post it in the chat at the bottom on the right, and we will get Mo to answer. Got some shy people today. Okay, Mo will be around. They also have a booth in the exhibit hall, so you could also drop by the Farms.com risk management booth and ask some questions. Mo, you mentioned you had a special deal on for this conference.
Yes, we do. So I mentioned earlier about the mobile marketing app. It's part of our delivery to get the commodity information and news that farmers need on a daily basis. So our program typically is $600 a year, but today is the last day. We're offering a 50% discount for anyone who is interested in purchasing that subscription. It's
All
great
right.
value.
Yes, it is. So if they are interested, they can just drop by the booth or send you a private message.
Correct.
Excellent. Okay, well, thank you very much, Mo. Have a great day, everyone.
Yep, same to you. Take care.